happened in the first innings before these Ilango and Mr. Jiva took over. There was a bull run uh, during 2002, and when energy prices went up. So when energy prices go up, or when your commodities go up, or in general the prices of your products go up, there is a good chance that your stock, your business performance will improve, and stock price will also resonate with that. But huge things happen when there is excitement around some asset coming online. So this is the thing in PY1. When PY1 in 2009, like there were news that PY1 will come online. Before that, the stock price spiked like anything. But unfortunately, PY1 did not deliver or live up to its promise, and it started faltering. And there was this PY3 asset also, which stopped production, which was a joint venture with some other guys, which stopped production, and the stock price again resonated. So, in general, there is a market cycle that is going on, which happened from 2002 to 2008. Then there is a capital cycle, or for the company itself, which happened in 2009, and the stock shot up like anything. So that's the capital cycle. And commodity cycle, market cycle are not generally always in line with the capital cycle. So as I explained, the investments are not happening in oil and gas. So while the markets might face the inflation, and the stock price might have, markets in general face headwinds, there might be tailwinds for uh, the capital cycle players. So I was reading somewhere during 1929, when there was real recession for almost 10 years, the only things that did well were commodities, because their capital cycle was playing in a different way. So commodities actually made money during those 10 years of flat out in US, from 29 to 37, right? So those market cycles and capital cycles play out somewhat differently for these companies. So you have to keep that in mind. Yeah. So learnings essentially, this is the second part of the innings when Mr. Jiva and Ilango took over. The write-offs happened, and then you got a buying opportunity for 2 3 years till the time D-Rock started producing. So and you got an opportunity to buy even at a lower price than management at some point. But when D-Rock started producing, the stock price again went up. Within a year, it became almost 3 4x. And then PY1 stopped. So some or the other problem has been coming around. And again, in the COVID crash happened, oil prices collapsed. So all those things coincided, and then you again got a buying opportunity which was there for you 3 or 4 years back. So this industry is a bit tricky in that sense. It can move very fast, and because of asset concentration, something not working out, the things can go against you or for you in much faster manner. So yeah, and when things are down and out, if you choose to make that bet, it might be much more rewarding. Okay. So this is the one thing that I think of a lot when I take any position. So there is this expected value framework which was there in security analysis, and Professor Bakshi has also talked about it. So if you guys play poker or something, you would understand that there are odds of winning, that is probabilities of winning, and then there are chances, like if you win, how much you can win. So as George Soros said, that it is not important how many times you are right or wrong, but it is important how much money you make when you are right, and how much you lose when you are wrong. So while in this case, the odds might or might not be in favor, even though probability of things working out might be less, but if things work out, you make a lot of money. And that is the kind of bets that I like to take. when things align that probabilities are also good and payouts are also good, that is the time when you take much bigger bets, right? Am I able to convey this framework clearly?
Yes, Manan, very much, very much.
Okay.
Completely agree with you there.
And obviously, obviously nothing is precise. You cannot point out that this is the probability or this is the exact amount of payout that I get. But you operate in ranges, and it will always be a game of incomplete information. You will not have complete information at any point in time. So you will have to adjust for that and make scenarios in what all can happen with good amount of probability. Now, I think this is a very common slide and most of you know the valuations. In this case, it is very tricky, but the thumb of rule that I follow for most of my investments is if things work out, then in how many years the profit can be equal to market cap, the cumulative profits. So if this is like 3, 4, 5 years, then it's a very good bet. And if you add high probability to that, then you get a sort of a very good expected value for your bet. So that is the general framework that I use, which I have used in case of HOEC also. And this is largely the risk reward ratio that I am working with at this point. Now, I have assumed, sorry, there are two scenarios that I am thinking about. I'm trying to move my video bar somewhere else. Okay. Uh, Now these are the two scenarios. These are not worst and best case scenarios, but let's say in a bad case scenario, if BAT, if oil is at $50, and that will determine the price of gas as well because it's a formula of 22%, then your I'm talking about the bad case. Then the EBITDA from BAT will be around 140 crores, and these are largely these are not exact figures. I'm just talking about what all can happen, and obviously currency also comes into play. So if Indian currency depreciates further, HOEC gets benefited because of that. Now, so in case of low energy price scenario at $50 a barrel, BAT will generate a 140 crores of EBITDA. DROC will do at $5 per MMBTU, 90 crores EBITDA. And the other assets, which are other fields, can do around 10 crores. Now, EBITDA from these products will be around 240 crores. Now, EBITDA from subsidiary. Now I'm considering it's largely a flat. It's a flat thing, but just to give you idea of good and bad case, I've changed the EBITDA to some extent, but it should largely remain flat in all the cases. Now, in the very base case, it can do an EBITDA of 150 crores, but there is a very high probability that it will keep on doing 200 crores of EBITDA. But let's say EBITDA of 150 crores, then the total enterprise value at for production oil wells, I've taken a multiple of 4, and for subsidiary I've taken a multiple of 6 because the variation is less. So we get a EV of around 1800 1900 crore rupees. Current EV is around 2500 crore rupees. Now the downside will be around 13-14% in my opinion if bad case plays out, if oil is right. And I might be completely wrong. This is just to give an idea of the expected value framework. Okay. uh, in the good case, if oil prices stay at $90 and corresponding gas prices for BAT, then BAT does a EBITDA of 340 crores. At $9 per MMBTU, DROC does a 170 crores EBITDA. Other assets do 30 crore. So overall EBITDA from those things would be around 540 crores. If you give a 7 times multiple, because if things are well, the multiple markets generally assign a good multiple. If things are bad, markets assign bad multiple. So multiple can be 7, and this is also a conservative multiple. In the past, it has traded at 20 times multiple also, but I'm taking just 7. So the EV in that case would be around 3,800 crores for the assets. And please remember that I'm not factoring in